for today's morning blast. Morning, Paul. Morning, Chris. Morning, Dom. Dom and Chris. I was the first. Dom and Paul. I was the first to join. Thank you very much for that. Where is Mr. Brown? He might be a little bit hungover because I did buy him a few beers yesterday. Here he is. Right. Let's invite him to get on board. Send invite. Morning, Hubert. Right. The invite is sent. I'll wait for him to join before I read the legals because he doesn't trust me, basically.
That is correct. I do not trust you.
Here he is.
Good morning, Ryan. Good morning, everyone.
I did in the pub after a beer recite the legals without checking them, but I'm not going to attempt
You
that
did, actually. You did very well. I
no
was
one
surprised.
was more surprised than me. Nothing discussed on this space in session constitutes trading or investment advice or infers any kind of endorsement by PIQ Global Limited, Trainers PIQ or PIQ Suite, or its affiliates, including the hosts, which, as you know by now, is the amazing Mr. Michael Brown, way, and myself, Mr. Ryan Paisley, way. Anyway, how are you, my dear friend?
I'm very well, thank you, mate. Thankfully, you didn't make that slightly peculiar noise when we were in the pub yesterday.
Yeah, right. I do make peculiar noises in the pub, but not that one.
Yeah, that's very true. Right, shall we move on from that, though?
Yeah, let's go.
Indeed, let's. Right, good morning, everybody. It was an interesting day for financial markets yesterday, and actually it ended up being quite a risk-averse one as well after US economic data sprung a little bit of a hawkish surprise. We'll get onto that momentarily, but to put some numbers on the moves that we saw yesterday, the S&P 500 ending the day down by around about 1.1%, the Nasdaq leading losses and trading down by around 2%, and the tech sector bearing the brunt of the market's ire as the long end of the Treasury curve continued to sell off, with 10-year yields rising by 5 basis points, 30-year Treasury yields rising by 6 basis points and climbing north of 4.9%. And as a result of that, the dollar ending the day broadly firmer, the dollar index rallying by around about 1/3 of 1%, trading north of 108.5 and gaining ground against most G10 peers. In terms of those hawkish data surprises, well, the first was the December ISM Services PMI print, which came in at 54.1, above expectations of a rise to 53.5 and a healthy increase from the prior 52.1. I think what really concerned market participants, though, was the prices paid metric, which rose to 64.4 from a prior 58.2, and that is the highest level since February of 2023, and certainly reinforces the idea that the Fed will skip the January meeting. Although I would just caveat that by saying that, and this is really a rule of thumb for any data releases in the month of December, things are just a bit weird at that time of year, whether it be employment, whether it be prices, whether it be economic activity. So do firstly just take it with a little bit of a healthy dose of skepticism. And secondly, bear in mind that we could see a bit of a reversal in the January number. And actually, I think the last 2 years running, the January ISM services number has been 4 or 5 index points lower than the December print. I remember this time last year when we got the January data, everyone was suddenly panicking about the US going into recession. So just bear that one in mind and look at things with a bit of a dose of caution.
If I may just butt in, because it saves me saying it in about 2-3 minutes' time, as we are talking about what the Fed might do and stuff. So just a shout out to our friends over at CME, and currently they on their Fed Watch page, which obviously is a must for most people. I think it's actually their most visited page on the whole CME Group website. After yesterday's numbers and stuff, the market's now pricing in a 95.2% chance that, as Michael Brown just said, the Fed skips any action on their, what is it, the December, what date is it? Is it
it's the 29th of Jan, I think, isn't it?
29th?
29th of Jan, yes.
There you go. Yeah, so that if you remember, yesterday it was about 91.4%, today 95.2%. So yeah, basically people that weren't already sure they're going to skip are now even more sure.
The other thing I would just say on Fed pricing, then we'll get back to my rundown in a second, is, at one point yesterday, the market was not fully pricing a 25 basis point cut until July. So it seems like we've just gone massively sort of overly over the top in a hawkish direction, whereas again this time last year we were massively over the top in a dovish direction. So I certainly
Yeah.
wouldn't rule out some of these bets being paired if data were to start
Yeah,
surprising
I'm
to the
just
downside.
looking now. So it's got like a 44% chance now of a cut in July. Oh, sorry,
Yeah.
June. Yeah.
There we go. The other hawkish surprise that we got out of the United States yesterday came in terms of the job openings data. Jolts at 8.098 million in the month of November, well above the top end of the forecast range and above the prior 7.74 million. Of course, this comes ahead of the December payrolls numbers, which are due on Friday lunchtime, although there is perhaps limited read across from one into the other. In terms of other bits and bobs from yesterday, then, just sticking with the bond market very briefly, it's caught quite a lot of attention what's going on here in the UK. We saw 30-year gilt yields climb to their highest level since 1998 yesterday, trading north of 5.2%. 10-year gilt yields, they're trading at their highest level since the middle of 2023. And we also had a 30-year gilt auction yesterday, which received its lowest demand since December of 2023. So, of course, we are seeing a sell-off across fixed income globally, but again, the UK is underperforming compared to peers, and this is the market remains incredibly concerned about the perilous fiscal outlook here in the UK. Just for a bit of context around that, of course, we have a fiscal event coming up towards the tail end of March. At the October budget, the headroom against the new target was about £15 billion. The OBR in their forecast document, which I had the pleasure of reading through yesterday,
Nerd.
well, yeah, some of us have to, noted that if gilt yields were 1.3 percentage points higher across their forecast horizon, that would wipe out the entirety of the headroom. Now, the first thing to remember is that the headroom is going to be lower anyway, because that's how things
Oh,
work. We're
fuck.
moving towards the tail end of the tax year. So most estimates are that headroom is probably going to be about 9 billion when we get to the fiscal event at the end of March. And just for context, the OBR's forecasts in October had 5-year gilt yields at 3.8%, and the 5-year gilt is currently at 4.44%. So just bear in mind that Rachel Reeves is, well, probably going to be going shopping for a lettuce, I would
Well,
imagine, at some point this morning.
just on this, save me reading it out in a second because it's very much directly related to this. So one of the headlines that Zach's picked out on the overnight news roundup is from The Guardian, which states that UK Chancellor Reeves could be forced to make fresh cuts to public spending at her March spring forecast as a rising government borrowing cost risks the Chancellor's breaking her own fiscal rules, which comes to very little surprise to many of us.
Indeed, and actually, I would take out the could from that and just change it to will, because it's painfully obvious that she's going to have to do that, or break some of these manifesto promises on tax. And let's be honest, the definition of working people has already been stretched to its absolute limit.
Yes.
Anyway, we could go on about that all day. We won't, because there's a few other bits and bobs I need to get through. We also had inflation figures out of the Eurozone yesterday. Headline CPI rising 2.4% in December, in line with expectations, up from the prior 2.2%. The core figure that came in at 2.7%, again in line with expectations and unchanged from the prior figure. In terms of headlines yesterday, I think I mentioned this this time yesterday morning, but I'm going to say it again because I'm not sure. And that is that China, they added to their state gold reserves for the second straight month as 2024 drew to a close. Of course, one of the things that propelled the yellow metal higher last year was purchases by emerging market central banks and monetary authorities, and it looks like China were continuing with that as the year ended. In terms of the Fed, of course, we heard on Monday that the Fed's Barr will be stepping down from his role as vice chair for supervision. Semaphore reporting yesterday that Michelle Bowman is the top candidate to replace him. Of course, Bowman was appointed to the Fed by President-elect Trump in 2018 and has probably been one of the most vocal critics of Barr's efforts to implement stricter regulation on the banking sector. Speaking of Trump, we heard from the Orange Man man yesterday. He held a press conference at Mar-a-Lago. The press conference was to announce a $20 billion investment for new data centers across the United States, but it descended into just complete rambling chaos, to be completely honest with you. Just to go through some of the nonsense he was coming out with. In terms of geopolitics, he was talking about how he is under discussion with Panama about the Panama Canal and refused to rule out either economic or military tools to deal with Panama. He also refused to rule out economic or military tools to deal with Greenland and threatened Denmark with tariffs because obviously, Trump now wants to own Greenland, and I guess why not? Speaking of military, he was saying that NATO countries should be spending 5% of their GDP on defence. Of course, the current target is 2%, and I think only about 3 or 4 countries in NATO are actually managing to meet that, so there's no chance that they'll get to 5%. Incidentally, and I haven't checked the numbers, I'm not even sure the US spends 5% of GDP on defence, so no idea what he's coming up with there. He was also talking about Canada, saying that they are considering economic force to deal with Canada, and that the US does not need anything that Canada has, which is complete nonsense. In terms of the fiscal side of things, he said that he does want to see an extension to the debt ceiling, which, for those who are interested, is a little bit of a deviation from his prior remarks, which he's probably forgotten, which were that he wants to get rid of the debt ceiling. And we also heard Trump speaking about the monetary policy side of things as well yesterday, saying that interest rates are, and I quote here, far too high, which I'm sure thrills Fed Chair Powell that he's going to have to deal with another 2 years of that nonsense. Of course, we are now 12 days away from Inauguration Day on the 20th of January. And last but by no means least, just to revisit a story that we covered on Monday, Getty Images and Shutterstock, their merger has been confirmed in what looks like a picture-perfect bit of M&A.
You absolute twat. Well, thank you for that. Let me, before I do, I'm sorry, frog in my throat. Before I do read through the headlines from Zach from the overnight news roundup, just a shout out to Zach for doing that for us. Also, shout out to Cam, who's doing more for us, more with PIQ on the crypto front, so bringing you all the latest news and developments on the crypto stuff. He's putting out recordings every morning that we're going to whack up onto Spotify and stuff as part of a podcast series, and also hopefully get some interviews with him and stuff like that, which is awesome. Also, obviously, a shout out to our friends at CME Group and our friends at Zishi. I can see Suzanne listening in. Zishi, for those of you who don't know, check them out. They're a global leader in financial services education. So please do check them out. But anyway, some headlines via our friends, our friend Zach. These are taken off the overnight news roundup that obviously we put out each morning on our Substack. Starting off in the macro space, obviously I'm going to start with the latest German numbers because they are absolutely awful. And we know I love a headline like that. German industrial orders fell unexpectedly in November, sapped by a decline in large orders, showing that a recovery in the industrial sector is not in sight. And the orders actually fell 5.4% on the previous month. And that's on a seasonally and calendar adjusted basis. Moving over to China, China stepped up its support for the yuan as the managed currency weakened towards the edge of its allowed trading range against the dollar. The central bank set a daily reference rate that was stronger than analysts estimated by the most since April this morning. We got sticking with China. China's been ramping up its suppression internally against those who cast doubt on its growth figures and outlook.
Xi said because himself, they're completely fucking made up.
Yeah, exactly. But I quote, they are muzzling certain economists. Yeah. So basically, if you want to tell the truth in China, you're going to get a muzzle strapped to you. What a way to live. Bank of America have said that the PBOC may expand its net purchase of government bonds next year. That's according to Zero Hedge. More Chinese regions are cutting electricity prices to help out their embattled industries, which is likely to worsen the squeeze on profits of power suppliers. Sticking with power, the UK grid operator issued a power market warning saying that there is insufficient buffer between predicted supply and demand on Wednesday, and that says wind output falls at the same time as temperatures plunge. It is pretty nippy out there, I'll be honest with you. Also, great sign of this this net zero kind of way we're going with energy production. The EU must be ready to defend itself against protectionist trade measures by other countries, including new steps taken by Trump. That's according to the bloc's industry chief. Worth noting as well, as we keep mentioning, the two on paper at least, the two powerhouses of Europe, France and Germany, don't really have functioning governments. Therefore, it makes any rebuttal to defend themselves, the EU to defend themselves against Trump, that little bit much harder. Moving over to India, India is considering revoking a 3-year ban on futures trading in 7 farm commodities, including wheat and unprocessed rice, after studies found that steps were counterproductive. Yeah, so this is, who would have thought it? You try and kind of pigeonhole, you kind of constrain a market, and it doesn't really act like a market. Who would have guessed that? Free markets for the world, my friend. In lithium, lithium glut, and the prospect that some mines could be restarted if prices rise means the battery metal is unlikely to mount a significant recovery this year. That's according to Bloomberg, so one for the battery names. Just one headline from our geopolitics section, and that's Israel-Lebanon ceasefire that claimed months of cross-border bloodshed is being strained as the two sides accuse each other of violations, and the US races to make sure the deal holds. And now a few equity headlines for us. Starting off with Volkswagen, management will take pay cuts adding up to over 300 million euros by 2030. Amazon plans to spend at least 11 billion to expand its cloud and AI infrastructure in the state of Georgia. The shares of IonQ and other companies linked to quantum computing tumbled in extended trading on Tuesday after hours, and that's after Nvidia, their chief exec Jensen Huang, said that very useful quantum computers are still likely to be decades away. So all that hype that we had a couple of weeks ago about quantum computing, maybe get back in your box a little bit. ExxonMobil expects falling oil prices to drag on for a fourth quarter. Exxon expects falling oil prices to drag on fourth quarter earnings, while higher gas prices will provide a boost. Sticking in energy names, Shell trimmed its LNG production outlook for the fourth quarter on Wednesday and said that oil and gas trading results were expected to be significantly lower than the previous 3 months. Nippon and US Steel are betting that Trump can be persuaded to back their $15 billion merger deal, accusing President Biden of blocking the transaction to win union support in last year's election. One for Tencent Holdings, which extended losses on Wednesday. They repurchased the most shares in nearly 2 decades on Tuesday after a sell-off sparked by the tech firm's addition to the US blacklist, and that's for alleged links to Chinese military. And finally, OpenAI CEO Sam Altman denies sexual abuse allegations made by his sister in a lawsuit. Oof. Back to you in the studio.
Yeah, let's not go down that route. Right, moving on in terms of today then. Overnight, we have had some inflation figures out of Australia. At a headline level, inflation coming in a little bit hotter than expected at 2.3% on an annual basis in November, up from the prior 2.1%. But the RBA and Aussie policymakers focus on something called the trimmed mean inflation metric, and that actually fell to 3.2% for a prior 3.5%. And as a result of that, we've seen a dovish repricing of rate expectations down under, with rate futures now pricing in around a 75% chance of a rate cut, a 25 basis point cut at the first RBA meeting of the year on the 18th of February, and that's up from around a 60% chance this time yesterday. In terms of the day ahead, the morning session, at least for those of us here in London, is relatively barren in terms of economic releases, although a busy calendar awaits stateside, of course, ahead of the National Day of Mourning in honour of Jimmy Carter, which takes place on Thursday, meaning that most US markets will indeed be closed tomorrow. In any case, the data that we have out today kicks off at 1:15 this afternoon, with the latest ADP employment figures due, expected 140,000 from a prior 145,000, although the resemblance with the official payrolls figures that we get on Friday is, almost non-existent at this stage. 15 minutes later, at 1:30, we have the weekly jobless claims data. Initial claims expected to rise to 215,000 in the week to the 4th of January, up from the prior 211,000, although neither that nor the continuing claims claims number will pertain to the December non-farm payrolls survey week. And of course, that data is due on Friday. Also today, we have minutes due from the December FOMC meeting. Of course, that meeting seeing the FOMC deliver a 25 basis point cut, amounting to 100 basis points of easing in total over the course of 2024. Although the December Fed meeting also saw a relatively hawkish dot plot, which implied just 50 basis points of cuts being delivered this year. As Ryan alluded to earlier, the market pricing now around about a 95% chance that the Fed deliver a skip at the January meeting. In terms of other bits and bobs to keep an eye on today, US supply continues with a $22 billion 30-year bond auction at 6 o'clock this evening London time. Central bank speeches today come from the ECB's Villeroy as well as the Fed's Waller. I think Waller will be very well worth watching at 1 o'clock this afternoon. He tends to be one of the more influential and market moving participants on the FOMC. And last but by no means least, on the earnings docket today, after the close this evening, we hear from Jefferies. Jefferies are perhaps something of a barometer for the banking sector more broadly. And of course, bank earnings and, well, earnings season proper kicks off with JP Morgan and their competitors reporting next Wednesday on the 15th of January. And that is pretty much your lot for this morning.
Well, thank you very much, Mr. Michael Brown. And listeners, thank you as always for tuning in. And we will see you all tomorrow. Keep it tight.
We will indeed. Bye-bye.
Goodbye.